Welcome to week 3. In week 3 we talk about the accounting information system. We're going to go through kind of the chapter, kind of some overview of each portion of the chapter, as well as I will try to do any types of problems or something that we have there. I will also have a separate recording for each of the exercises you have to do, kind of explaining more of what you need to do for your homework. So let's start off with why an accounting system is needed. Definitely if you're a publicly traded company, you have to have some type of accounting system in place, mainly because you are required to be audited externally by an external auditor. So an auditor needs your accounting system to be in shape and understand what you're doing so they can audit your books and ensure that your financial statements are accurate. For those who are privately held companies, the biggest thing coming right off of tax season, as I finished it this week, is it helps your accountant to be able to prepare your taxes, as well as it will help you as a business owner to be able to see what your expenses are, what your income is over a 1 month period, 3 month period, a year, several years. So and that's where it kind of explains at the beginning of your chapter about what an accounting system is. Page 84 and 85, there's some basic terminology that's listed there. Make sure you go through and you understand what each of those things are. We'll talk a little bit more about some of them. One of the biggest ones to make sure you understand is real and nominal accounts. What the difference of between the two are. Typically your real accounts, they're permanent accounts. They're usually going to be on your balance sheet. And your nominal accounts are what we call temporary accounts. And what is meant by that is each month, at the end of that month, we clear that account. We want to take that account back down to zero, and then we start over at the next month with adding transactions into that. We'll also talk about the trial balance. The first trial balance we pull, after doing adjusting entries, we'll pull a trial balance, and then post-closing trial balance. There's 3 different trial balances that you would be looking at given at each particular time. And then we're also going to go into adjusting entries and closing entries. So on your page 85 and going into page 86, it talks about debits and credits. You should be kind of familiar with your debits and credits from previous accounting classes that you may have had. And it also talks about the accounting equation. I get a lot of students who say they can't really remember, how everything goes as far as what increases something, what decreases something. So one thing I always like to do, and I'll use this board, is that's your accounting equation. Assets equals liability plus stockholders' equity. Of course, you could write it out, but that's just how I remember it. But one thing I also do, keep in mind at this point, that's a T account already. Your assets, your liabilities, stockholders' equity. On this side of the equation, assets, you have debits, credits, and this. So on this side, your debit is going to increase these accounts, and your credit is going to decrease those accounts. On the other side of the equation, you also have debits, sorry about my handwriting, and credits. And on this side, your debits decrease the account, and on this side, credits increase that account. Okay? So I kind of look at it like I put my thing together, my assets equal liability plus stockholders' equity, and then I always think plus, minus, minus, plus. That's how I know. Plus, minus, minus, plus. And then I say, okay, debit, credit, because a debit's always on the left-hand side, and then a credit's always on the right-hand side of whatever account you're doing. It's just a matter of when does it increase, when does it decrease. So make sure you've actually looked at the different accounts that they mention on page 86 and 87. If you notice on page 87, there is at the top of the page, it has your accounting equation once again listed there. But then it also has a couple of different accounts down on this side. Remember, on this side, it would be our debit would increase, or our debit would decrease, and our credit would increase. Well, on page 87 at the top, it shows you in dividends, if you have a dividend account, that's where it's going to be different on that side. A debit's going to actually increase that side. And then also an expense account. a debit's going to increase that side. So only on those two accounts that fall on that side of the equation will a debit increase that account and a credit decrease. All the others on there, a debit would decrease and a credit would increase. Okay? Let's see. So make sure you know what happens to each of the different accounts when a debit and a credit is involved in that. So let's move on to page 89. We begin talking about the accounting cycle. There's an illustration on page 90, illustration 3-6, which takes you through the accounting cycle. There's 8 to 9 steps involved in the accounting cycle. First, you need to identify the transaction itself. That's not one of the actual steps, but you want to identify what the transaction was, whether it was purchase, some office supplies, received income, whatever it is. But your first step is actually to journalize whatever that transaction is. And that would be where you are making a difference. You're mentioning which accounts are being impacted and which accounts, what gets a debit, what gets a credit. We're going to do a journal in here in a second. Your next step would be posting. Posting means after you've done all your journals, you go back and look at those journals and say, okay, how many times did the cash account be impacted? I need to make all those transactions, move them over into the cash account. That's posting. I need to post them all to that cash account, or maybe I need to post these all to supplies. So that's where you're going to identify them and group them all under whatever account they fall under. After you do your posting, you're going to pull your initial trial balance. Your initial trial balance is just going to show you each account that you have, and it's going to also show you the debit and credit of each of those accounts, which is their normal account, and what their balance is. After you've done that, you're going to go in and make adjustments. We'll talk about adjusting entries, but your adjusting entries are going to be things such as maybe we have to adjust for prepaid insurance. After you've done adjusting entries, your next step would be to go in and pull an adjusted trial balance, which is just what it says. After we've adjusted transactions, we need to go pull an adjusted trial balance, which is going to show us other updated figures once we've done those adjustments. After adjusting trial balance, we can then prepare each of our different financial statements. And one thing to keep in mind with the financial statements, there's 4, but 3 are our main ones that we usually look at. Our income statement, also known as a profit and loss. It has to be completed prior to being able to complete the next statement, which the next statement would be retained earnings. And that has to be completed before you can complete your next one, which is a balance sheet. Okay? And we'll talk about each of those. After you've completed your financial statements, now you can do your closing, which means where we want to move everything in those nominal accounts, which are temporary accounts. We want to move that all over to a main account and zero back out those accounts, those nominal temporary accounts. And then we pull a post-closing trial balance. That one is afterwards, when we pull that post-closing trial balance, it should show us all the accounts that are what we call real accounts only. We should no longer have any of our nominal temporary accounts on that trial balance after we've done our post-closing. And then the last step, which is an optional step, is doing reversals. Maybe you notice that there's an error or something and you need to make a reversal on something. That's where you're going to do your reversals at the very end. Okay. So looking at page 91, we talk about journaling. And journaling, as you see, if you're looking at that, it shows you the date of the transaction. It's telling you which accounts are impacted with that transaction and what side gets a debit and what side gets a credit. And if you notice, every time on each of these transactions, they equal one another. Your debits must equal your credits. So the first one on page 91 talks about there's a cash account involved. Cash was debited for $15,000, and then common stock was credited for $15,000. You had a debit, you had a credit, they both equaled each other. Okay? All we're doing is just putting down what happened. That's journaling. Now we'll move on to our posting, and when we're looking at posting, going back to that first example with the cash and the common stock, now we realize, okay, I have a cash account with a debit of $1,500. I need to move, or $15,000. I need to move $15,000 over to an actual cash account. And that's where illustration 3-8 shows you that it says general ledger, cash. Every transaction that had a cash account involved with it, we're moving it over to just that cash account. Every transaction that had a common stock involved with it, we moved just that amount that was on the common stock. So common stock, we moved over 15,000 credit, because that's what our original journaling was. It was a credit. And then cash, we moved over 15,000 debit, because that's what our original transaction was. Okay, so once in this, and the pages following just shows you more of the actual journal entries, and then shows you the posting entry. So make sure you understand that. The journal entry, and then what happens with the posting entry. The posting entry is when we move everything over that involves that account to that particular account's ledger. Then we're pulling our trial balance. Page 96, illustration 3-19, we have our trial balance. It lists every account that has any type of balance, whether it's a debit balance or a credit balance. It shows us all the accounts, cash accounts, supplies, notes payable, everything is listed there. Okay, so now we want to do adjusting entries. The reason why we would do adjusting entries would be, for example, let's say you have a business and your insurance for the year was $1,200. You paid the full amount for the year, $1,200. You put in that full amount in your journal and posting of $1,200. However, if you're an accrual-based company, you can only recognize what you've used so far. You may have paid $1,200, but at the end of the month, you've only used 1 month of that $1,200. So that's where we have to do an adjusting entry to note only 100 of the 1,200 has actually been used. And the reason you can think along the lines of, if you decide at the end of that month you want to get a refund, you no longer want that insurance, you've traded to someone else, you've decided to go to a different insurance company. That insurance company needs to credit back to you or send back to you how much of that insurance you did not use. Remember, you only used 1 month, so you only use 100 of the $1,200. So they will be returning to you that $1,100. So that's why we do those adjusting entries. You adjust for those accounts that you've only used that much of each month. Okay. Now, if it's a cash-based account, cash basis means the moment that transaction goes through, you recognize the whole amount regardless. But most companies will work on an accrual basis versus a cash basis. So that's why we have to do those adjusting entries. And then your book shows you, it also talks about on page 97 some types of adjustments, such as prepaid expenses of insurance, whatnot, or accrued expenses, or maybe even unearned revenue. Maybe you've done a service for your business, however they haven't paid you yet. You are entitled to that revenue, so it's unearned revenue. Although you haven't received it yet, we want to adjust for that. Okay? Okay, so then we move on after we have done our adjusting entries, and pretty much from page 98 over to, let's see how far this goes over to about page 107, it's all talking about adjusting entries. So make sure you've kind of looked that over and become familiar with adjusting entries and why you would need to do those adjusting entries. But page 108, we get into the adjusted trial balance. Recall previously we pulled our first trial balance, showed us every account and what the balances were, whether it was a debit balance or a credit balance. Our adjusted trial balance is we pull that after we've made adjustments. And as you see, there's been some adjustments in our balance, in our trial balance. We still have every account, and we still have debits and credits, but the amount has been adjusted because of the adjustments we've done. Okay. Once we've done that, now we can actually pull our financial statements. Remember, I said you have to be able to create your income statement prior to being able to create the others. The income statement gets its information off of that trial balance. So that's why or that adjusted trial balance. So that's why it's important that we make those adjustments for that adjusted trial balance. We then use that information to create our income statement, and this is on page 109. From our income statement, our net income will feed down into our retained earnings. Okay, And then once we've done our retained earnings, the bottom line figure of the retained earnings then feeds over into our balance sheet. So all of these are tied together. You can't do one without the other being completed first. So that'll tie over into our balance sheet. And that's how we create our income statement, our balance sheet, retained earnings. After we've done all that, now we're ready to close the month. And what we mean by that is at the end of the month, it could be the end of the year, but typically every month we want to close out those no-meal accounts. So all those temporary accounts, we want to close them out. How do we do that? They have an amount in there. We need to adjust for it somewhere. And that's where it's showing you on page 111. We get into the closing entries. It's showing you what the different journal looks like. Service revenue, $106,000. Income summary, $106,000. So to close the revenue account, we need to adjust for those. And that, we put that in. That's what closed our revenue, or service revenue account. Okay? So we're taking the amount that was in the service revenue, and I'm going to refer you back to page 110 in that illustration. Towards the middle of that illustration, it shows you on the adjusted trial balance, the service revenue had a credit account of $106,000. That's what we're putting in on our closing entry. Service revenue, $106,000. Notice on that, let me show you this. Notice on this report, this one over here, it has a $106,000 credit balance. Okay? In order to close it out, which we're closing it out over on this page, we go in and put service revenue debit of $106,000. Okay? That's what's going to close that account. If it has a credit balance, I need to debit it in order to bring it to zero. And we're going to, when we debit it, we're really taking that $106,000 and moving it over into our income summary. Okay? And that's what we do with each of those temporary accounts. If you notice, the next transaction under there is pretty much all some type of expense. Expense accounts are always temporary accounts. They're only for that month. You don't want to carry over. If you spent $100 in office supplies in the month of March, you don't want to carry that $100 into April. When you pull your April statements, it's going to make it look like you spent that $100 in April as well. It was only spent in March. So at the end of March, we want to zero that office supplies account so we can start over at the beginning of April. Okay, so that's where it's showing you all of your closing accounts. And then after we've closed out our accounts, we move on to our post-closing trial balance, page 113. Once again, it's showing us all of our accounts. However, if you look at your previous adjusted trial balance on page 110 and then compare it to this new one, which is the post-closing trial balance on page 113, you will notice that some accounts are not showing on the post-close trial balance. And that's because we zeroed out those temporary accounts. So what's on your post-close trial balance now are your real accounts. For example, we had our service revenue. Let's go back to that one. Service revenue account on our adjusted trial balance on page 110. But when we get done with our post-closing things and we close out, we look at our post-closing trial balance on page 113, that account is no longer there because that was a temporary account. We closed it out and rolled it into one of our permanent accounts. Okay? And then reversing entries, that's an optional step, but maybe if you realize there's an error done or something, that's when you will go in and create reversing entries, and you would just reverse whatever the transaction was. Maybe at the beginning we impacted our cash and common stock, but we realized no, it shouldn't have been common stock. We may need to reverse out that transaction for common stock and then put it into the correct area that it needs to be into. Page 114 at the top lists the accounting cycle summarized into, it shows 9 steps, but it's typically 8 steps. Really, it could be 7 steps since the post-closing trial balance and the reversals may not need to be done, but it's always good to kind of look at your post-closing trial balance, but it's not always necessary, and it's definitely not always necessary. Reversals need to be done. You may have had a good month and everything was entered correctly, so there's no reversals needed. Okay? And that pretty much sums up Chapter 3. I am going to make sure that I send you a separate link on each of the different homework problems. I believe you have homework is exercise 3-2, 3-6, and 3-18, as well as you have to answer 2 questions, question number 1 and question number 4, which we've kind of talked on, so you should be able to answer those. So be looking for the link for each of the different homeworks, where I'll kind of go through, you know, how to begin the homework or what you should be doing, and maybe show you one of the transactions. Okay? Thanks for week 3. We're ready for week 4 next week. Have a great day.